Having explained your buy approach, can you give us a few names of companies that meet your criteria?
Absolutely. We're finding a lot of value in the market. In the last year, certainly we found some great values late last year and into this year. And the market's better, our fund is doing well, so we all look smart. But we do think there's some great stocks that we've been able to uncover. Some stocks that really haven't participated yet. One example would be Myriad Genetics, which is a molecular diagnostics company that is benefiting from preventative medicine that's occurring in the United States mainly now. That's where 95% of the revenues are coming out of the U.S. But they have a test that will give a pretty accurate reading to whether or not you're at risk for breast cancer, ovarian cancer, or colon cancer if you have family history of the disease. So this product is being well received in the marketplace. It gets favorable reimbursement. The problem is the economic headwinds that the country's facing has caused some investors to, some consumers to not go to the doctor for their annual checkup. They're postponing physician visits. So because of that, the test levels are down. But the tests that this company have are very unique, and they're protected by patents. The gross margins are very high. The gross margins are close to 90%. Their operating margins are north of 40%. So the alarm bells are going off for me that this is a very, very unique asset because the gross margins are so high. In fact, when you compare their margins to other lab companies like LabCorp and Quest Diagnostics, which are a little bit bigger in size, in terms of revenues, they're much bigger. In market cap, they're bigger. But the gross margin profile is half of what Marriott's are. So we really like the profitability aspect of the company. We think that it was a growth company that's now a broken growth stock. We think the company is still intact. They had a money-losing biotechnology research division. They just recently spun off to shareholders. So right now the balance sheet has over $300 million in cash, or $400 million net operating loss carry forward. So there's $700 million in value there. The market cap of the company is roughly $2.5 billion. And we think that once the economy stabilizes and starts to improve, that patient volumes will start to pick up. We think it fits well with the Obama healthcare plan in that it is preventative, and it also saves the healthcare system money by diagnosing the disease earlier to treat it at an earlier stage where the disease would need less drug therapies, which are very expensive in oncology. So that's another benefit to this story. So that's one that we think over the next 2 years, either the company will recover due to economic recovery on its own merit, or we think the franchise is so valuable that someone else would want to own their tests. To give you another insight, the gross margins are comparable to a pharmaceutical company like Amgen or Genentech before it was acquired by Roche. We think Roche is trying to develop a great oncology franchise. They have drugs. They also have laboratory testing as part of their business, and we think is a great fit for a company like Roche. So we think that either the company will take care of its own business, or the franchise is so valuable it'll be taken out by a bigger company. That's a healthcare story that really hasn't participated yet in this recovery. We like the semiconductor space. It's had a good run. We think that it's probably getting a little more difficult to make money there, but there's still a few opportunities that are probably left behind. And one example would be IDTI, which is a semiconductor company that's levered to the PC universe and also the communications end markets. PCs are over 50% of their business, and with Intel reporting last week that things are pretty good, we think that the outlook for their PC business is pretty favorable going into this earnings season. They're currently at close to break even on a GAAP basis, from a GAAP accounting basis. Their cash flow is much better. They're a vertically integrated producer of chips, which means that they own their own fabrication facilities, so they actually make the chips, they just don't design them. There's been a move in the industry to go to more outsourcing, and what this company, I believe, will do that as well over the next 2 years. So I think you'll start to see them reduce their investment in capital equipment. And when that happens, their depreciation expense will go down on the income statement. So when you review the income statement, the company will look much more profitable. And the gross margins, because it won't be boom and bust due to inventory concerns like we've had the last year, because they're not making the chips anymore. They're going to just design them. The gross margin fluctuation will also be reduced. So I think, what does that mean for an investor? I think that the PE multiple probably ends up going a little higher for this company during the next cycle. I think during a downturn, the business model probably gets protected from gross margin erosion, unlike it did during the last couple cycles where it was vertically integrated. So therefore, I think the earnings power of the company coming out of this, I think they could earn 50 to 70 cents. So if you take the midpoint of that 60-cent estimate in earnings power over the next 2-3 years, you put a market multiple of 15 on it, you get to $9. They have $2 a share in cash on the balance sheet now. So if you add that back to it, you get to a stock that could be, north of $11. The stock's currently trading at $6.50. So we think there's a lot of upside there, and we also think there's some great catalysts on the change in how they run their business going fabless. New management team comes from both the CFO and CEO come from pure analog companies. Maxim Integrated Products is where the CEO worked prior. These are all companies that specialize in analog expertise. Maxim and Mike Krell is where the CFO was prior to joining IDTI. And these companies are all specializing in analog semiconductors, which generally have higher gross margins. So I think they're going to take what they learned at those companies and try to increase the amount of analog content in their chip designs. So the chips will have both a mixture of digital and analog, but more analog, so the gross margin should also go up. So I think there's a tailwind for improvement in gross margins between the going fabless and the design wins they have, and a recognition by the marketplace as the depreciation expense goes away from the income statement, that their profitability will show through, and give investors that didn't look at the cash flow statement what they need to see that the company is actually more valuable than they were thinking it was by just looking at the income statement. Okay. So those are two examples of a healthcare company and a technology company. We like both of them.
Well, those were all great insights, Sam. Again, I'm Ben Shepard, editor of Lewis Fruit Mutual Funds, and today we were joined by Sam Dedio, portfolio manager of Artio U.S. Small Cap, JSCAX. Thanks very much.
Thanks for having me.